In 2013, I went to the two founders of CMT and I suggested that they take a look at Bitcoin from an investment standpoint. I think they were horrified. We're used to trading in the traditional markets and regulated products, and they weren't such a fan of that idea. But they encouraged me to get involved from a legal and regulatory standpoint. So we got very involved with groups like the Chamber of Digital Commerce, and as the different states in the United States were trying to figure out how to regulate virtual currencies, we would go in, talk with the legislators and regulators, and help educate on blockchain technology. I've also done that in Congress. I've gone with the Department of Commerce to the UAE and Singapore on certified trade missions to exchange ideas on blockchain technology. I've also been a delegate with the United Nations and their Financial Inclusion Working Group. Needless to say, this legal and regulatory piece of CMT Digital's business is a core component of what we do. We care very much about it. You can't really build a business in this space on a fragile legal foundation. In 2016, so it only took 3 years, January of that year, the firm decided to invest in Bitcoin. We then launched a full crypto trading desk at the beginning of 2017. We started investing in the space the fall of 2017. Portfolio investments include Block, Abra, Circle, Templum, Silvergate Bank, and a few more. And so the three core components of our business consist of legal, policy, regulatory work, investing, and trading, and they all work synergistically together. So usually when I talk about regulation, investing, or trading, but today I thought I'd talk a little bit about the ecosystem here in Illinois for blockchain crypto assets. I think that in order to have a healthy ecosystem for a new industry, you really need 4 components. 1 is government involvement, regulatory clarity. 2 is academic institution involvement. 3 is trade associations and other advocacy groups. And the 4th is the involvement, kind of the health of the startup community and mature institutions. So let's go through each of those. So the Illinois Blockchain Initiative, I'm always very surprised how many people are not familiar with it. This was launched in November of 2016. And the state of Illinois realized that it had an opportunity. New York had put out this bit license regime that is, pretty much universally viewed as being very onerous. And a lot of companies were leaving the state of New York. Similarly, California, although it did not have legislation out there, just really couldn't figure out what it wanted to do with crypto. So Illinois kind of seized the opportunity and decided that they would put together this Illinois Blockchain Initiative, which consisted of 3 components. The first was clear regulatory guidance that was friendly to the industry. So in Illinois, crypto is not money and is not regulated as such. The second piece, which is the government itself decided to engage in 5 blockchain pilot programs. Those include property deed recording, academic credentialing, an energy credit market, vital records, and health provider registries. So it's always interesting. One of the challenges we've had historically just trading in the traditional markets, especially in the high-frequency trading space, was when that industry really started, some of our regulators did not understand what they were regulating, and that is a very challenging place to be in. With the government leading this effort in Illinois and engaging in these pilot programs, you have a government here that understands what they're regulating, which is really significant in a nascent industry. The third component was just an educational piece. So the state of Illinois has put on, believe it or not, month-long hackathons. They've brought in professors to teach smart contract coding. I mean, it's really ahead of the curve. With respect to academic institutions, we've seen involvement from DePaul, University of Chicago, Northwestern, IIT. CMT Digital tends to work more closely with DePaul and University of Chicago, so I'll just touch on those 2 briefly. At DePaul, there's a professor, Lamont Black, who used to be with the Federal Reserve. He started teaching about Bitcoin in 2014 as part of his banking and money course. He would always cover Bitcoin at the end as the future of money. And he says that what's really changed in his teaching today is Bitcoin is now at the beginning as part of the what is money discussion. DePaul similarly has put on coding hackathons. They have a class in the computer science department teaching kids how to code on the Ethereum blockchain. University of Chicago, we've hosted cohorts of students at CMT Digital who are interested in the space to come and sit on our trading floor, meet our technologists, just understand what it's like to trade in the spot and derivatives markets in the space. The Polsky Center also just did a new venture challenge where a distributed ledger technology company, Manifest, which is trying to use DLT to make 401k transfers more streamlined, won that challenge, which is really fantastic. And kind of showing the ecosystem, they then came into CMT Digital and we looked at them from an investment standpoint. So it's great that we're seeing that growth here. With respect to advocacy and membership groups, the two we work the most closely with are FinTech Chicago and the Chicago Blockchain Center. So FinTech is a nonprofit organization. They actually, in 2015, sponsored a series of roundtables that I did, talking about Chicago being the perfect place for an industry-led self-regulatory organization for crypto exchanges. It was way too early, but we are now working with the Winklevosses on their initiative to try and do the same thing. FinTech has also hosted international delegations here in Chicago to exchange ideas on blockchain technology. They were very significant in the start of the Illinois Blockchain Initiative. They've just been fantastic. The Chicago Blockchain Center was originally launched in the summer of 2014 by Matt Rozak as the Chicago Bitcoin Center. They sort of rebranded and relaunched in June of 2017. And just in the space of a year, they've hosted over 40 different meetups, conferences, events, and they also have partnerships in place with local universities. And then finally, mature institutions and startups in the space. So obviously we have all the trading firms, proprietary trading firms are pretty much involved in the space now, including CMT Digital, Jump, DRW, Acuna. And then obviously we have the CME and SIBO, and the significance of those two institutions entering the space really cannot be emphasized enough. It was a true turning point, I think, for the industry. But in addition to the trading space, we also have non-trading companies that are starting up here. We have Block, which was co-founded by Matt Rozak and Jeff Garzik, who was one of the Bitcoin core developers. And they develop blockchain enterprise solutions for companies, open source basis. We've also got Digital Mint, which manages over 100 different crypto ATMs. We have Attest, which is actually co-founded by the two sort of founders of the Illinois Blockchain Initiative, which is an identity solution. And then Manifest, the group that won the University of Chicago New Venture Challenge. So on this topic of the strength of the Chicago ecosystem, I'll leave you with kind of one thought, and then I'm going to share a couple of thoughts I have on the regulatory side. But Rumi Morales, who used to run the Chicago Mercantile Exchange's venture group, recently joined a group called Outlier Ventures. And Outlier focuses on the convergence of AI, Internet of Things, and blockchain technology. They're based in London, and they wanted to have a presence in the United States. So Rumi's not from Illinois. The first time she came to Illinois was for that CME job. And she could have started that position for Outlier anywhere in the United States. They didn't care where she started it. They left it up to her. And Rumi decided to start it here. Like me, she feels that Chicago is in the pole position in the state of Illinois to be the state that really becomes the headquarters for innovation in the blockchain technology space. So I would encourage all of you, and I'm happy after this to share those resources, but there's just so much happening here, and it's such a healthy ecosystem. So just to be aware of kind of how robust it is and how much work has gone into that. So I thought, since I do talk about regulation a lot, and I didn't want to put anybody to sleep, but I would leave you with a couple of thoughts there. And I always think it's helpful to start with the size of the crypto asset market and kind of just taking these factors that our regulators are looking at and putting them in perspective, because it's not an easy job that they have. So the size of the market, as of earlier today, I think we were at globally 270 billion in crypto assets. Google, 800 billion, and I think today Apple hit 1 trillion. So those are single US companies, right, compared to the global size of the crypto market. So it's very small. Although it's small, it's grown tremendously. So January of last year, Bitcoin was trading around $960. Today it's $7,600. Ethereum, I think, was $8. Now it's like $420-ish. So it's growing. Most of that growth, though, is still coming from retail investors. Although we have seen some institutions come in with CME and CBOE listing Bitcoin futures, those institutions tend to be proprietary trading firms like CMT. Most of the large regulated financial institutions are still on the sidelines, primarily for two reasons. One, we still need more regulatory clarity in the United States, and two, we need a lot of infrastructure built into the space, including prime services, mature borrow and lending facilities, mature custody facilities, better trading tools. So all of that is yet to come. The other piece that I think is important to mention is that most of the trading in crypto assets takes place outside of the United States on unregulated exchanges. So let's take a look at what our regulators are dealing with, right? So they are dealing with a relatively small marketplace with retail investors trading in highly volatile assets, and it's growing. So at this point, the crypto asset space, I would argue, does not pose any systemic risk. But the regulators, have to take those factors into consideration in how it's growing. So there's two things that kind of keep me up at night in the space. The first is, I think it's critically important for the United States to participate in this new asset class similarly to how we participated in the internet, from an economic, standard setting, and security standpoint. Unfortunately, this concept of regulatory arbitrage is real, and it's happening. I can't tell you how many times I talk with a team in Singapore or Zurich, Malta, Gibraltar, and they're Americans who have moved to jurisdictions where they think the regulatory environment is more clear. So I always like to think, what would it be like today if we overregulated the internet? And instead of Silicon Valley participating the way that it did, that happened in China, for example. I think we're at a real risk of that happening in the United States, where all of these innovations are going to happen offshore, which means we won't participate as we should from an economic, security, or standard setting point of view. So I think it's incumbent on our regulators to try to find that balance between consumer protection and not stifling innovation. It's also incumbent on the industry to self-regulate. So where there are gaps in regulations, I think the industry itself needs to step up and put together best practices and standards. We're starting to see that finally, but we need more of it. The second thing that kind of keeps me up at night is I was at a dinner recently, and the individual who I was with, who was a former chairman of the SEC, mentioned that we have 50% fewer public companies than we did 20 years ago. And part of that is because our traditional companies are IPOing much later in their lives. What that means, though, is that until a company IPOs, typically the only people that are able to participate in that value creation on the way up are accredited investors. So individuals with $1 million in net worth or $200,000 in annual income. If you can even get a piece of that, right? Like I know even if I met the accredited investor standard, I highly doubt I was going to be invited in for Facebook or Google when they were private, right? So I think with this new asset class, we have an opportunity to allow non-accredited investors to participate. We have this opportunity to sort of be more inclusive from a wealth standpoint. And so it makes me think about, is the accredited investor standard the right way to think about suitability to invest in these new technologies? I know plenty of developers and technologists who do not meet that standard and clearly know more about the technology and the prospects of these investments than many accredited investors. So I think this is an opportunity, again, for us to kind of think through how should suitability be determined for this new asset class? How can we put in place the proper guidelines to allow more wealth inclusion and participation in the United States, but also have, obviously, the right protections in place? I always think it's interesting to note that when our securities laws were put in place in the 1930s, suitability was determined based on disclosure of financial information, that all of the material facts, risks were made known to the investor. And then we trusted the investor to make the decision that was right for that investor. And it wasn't based on wealth. That concept of wealth was introduced in the early 80s. So I think that with all the data that's available today and the way that it's available, maybe there are ways to go back to just transparency and making sure that we have proper disclosures in place and inviting more people to participate in this asset class.